then follow us on the ProsperUS website itself, which is prosperus.asia. So check that out for the latest up-to-date content on markets. Okay, so without any further ado, I will hand over to Victor, Mr. Victor Tan, to go through his presentation on First REIT. Victor, over to you.
Thank you so much, team. Good afternoon to everyone that is joining us today. Thanks so much for taking your time off, of your busy schedule to join our webinar today. And I'm aware that this is your lunchtime, so it's really very precious to you. So I hope that what I will cover in my slide presentation today will be of benefit as well as be fruitful to you. Okay, so I will quickly touch on my presentation, and hopefully I will take about maybe 20-25 minutes to give you a quick overview of First REIT, and then I will leave the rest of the time for you to ask me any question, any burning question that you may have, with regards to our REITs. Yeah. Okay, I will begin by giving you a very quick overview of First REIT. First REIT is actually the first healthcare REIT to be listed in Singapore Stock Exchange. We were listed in December 2006. Okay, we started with 4 assets, coming from Indonesia, but over the years we've actually grown to about 32 assets across 3 countries, in Asia, over the last 16 years or so. Okay, so our mandate has always been to invest in healthcare or healthcare-related real estate in Asia as well as outside Asia. Okay, and we have this vision that we want to be to become the Asia premier healthcare trust. Okay, our asset size as of now is about 1.2 billion Sing dollar in terms of asset under management. It's spanned over 3 countries. Okay, Indonesia, which consists of about close to 73% of our AUM. There are 15 assets there, which are 11 hospitals, and we have 2 integrated hospital and more, and then we have 1 integrated hospital and hotel, and we also have an integrated hotel and country club over there. Next country is Japan, which we have about 24% of our AUM there. These are all nursing homes. We have 14 nursing homes in Japan. And then over at Singapore side, which cover only about 3% of our asset portfolio, we have 3 nursing homes there. Okay, so if you look at our existing portfolio in terms of healthcare asset, we own mainly hospital and nursing home, but our mandate actually allow us to look at other form of healthcare asset as well. For instance, any form of healthcare facility, such as medical suite medical offices or specialized pharmaceutical storage, outpatient facility, even life sciences innovation as well as research property. These are all covered under our mandate as well. Of course, we will look at nursing home, we look at aged home, senior living, any form of healthcare facility, we certainly can explore. Okay, and our sponsor, okay, we have actually 2 very strong sponsors, which in total owns about 44% of First REIT unit. They are actually 2 listed companies, OUE as well as OUE Lipo Healthcare. If you look at our leases, are all very long dated, okay, and is single tenant, okay, because of the nature of our asset, hospital or nursing home. So we have 1 tenant in each of our assets, hence we are 100% in term occupancy. Okay, if you look at our Indonesia portfolio, they are on 15-year lease with option to renew for another 15 years by future agreement. And then over at Japan side, the nursing home are all very long dated as well. They are either 20-year or 30-year lease term. Okay, and then Singapore side is actually 10 years with option to renew for another 10 years as well. Hence, our weighted average lease expiry is around 13 years. Okay, we also have very healthy financial position. Our current gearing ratio is only about 35.6%. That's as at June this year. You know that the statutory limit is about 50%, so we do have some headroom to gear up. So if we were to go all the way up to 45%, we actually have another 200 million of headroom. Okay, next. Okay, since last year, December last year, we actually came out with this 2.0 growth strategy. And that is basically to prioritize the sustainability of our distribution to our unit holders. And we want to pursue sustainable long-term growth. Okay, and there are a couple of pillars in this 2.0 growth strategy. Number one, we want to diversify into developed market. Okay, prior to this year, close to 90% of our portfolio are actually in one country. Okay, but since beginning of this year, we've acquired a couple of nursing homes in Japan. Hence, we have already diversified into developed market. 25% or slightly more, 26-27% of our AUM is actually in developed market now. Okay, so our goal is actually to increase our portfolio in the developed market to more than 50% of our asset under management over the course of next 3 to 5 years. Okay. Second our strategy is that we want to also reshape our current portfolio so that we can actually use that for more capital efficient growth. Okay, which means that we want to recycle capital from non-core, non-healthcare asset as well as mature asset. Okay, what I mean by non-core is that if you look at our existing portfolio, which I shared earlier on, you see that we actually have some integrated hotel and mall, and integrated hospital and mall, and then integrated hospital and hotel. And we also have a hotel and country club, which is not part of our core asset because these are not part of the healthcare asset. I'm referring to the mall as well as the hotel portion. Okay, so these are assets that potentially we are looking at divesting so that we can recycle to the more capital intensive or more capital efficient growth, which is the healthcare asset. Okay, and also for those mature assets, for instance, we have this existing hospital Surabaya, which was built in the 70s, already more than 40 years of age. Hence, we've decided that this is the best time for us to divest it as well as realize the full value. Hence, a couple of months ago, we have actually divested this particular asset, and we have actually used that proceed, to part of the loan, and we can actually use that to fund future acquisition, which we did by buying 2 more nursing homes in Japan, which I will talk more about that in the following slide. Okay. So another of our strategy, another pillar of growth is that we also want to strengthen our capital structure so that we can remain resilient. Okay, especially we are looking at growing our portfolio so that we want to be able to look at various funding sources, funding options, so that we can diversify our funding sources so that we can continue to optimize our financial position. Okay, and then and also part of the growth strategy is that we want to continue to pivot to ride the later mega trend, like for instance the environmental, social governance, which ESG, aging population demography, as well as the under-penetrated healthcare sector in the developing country. Okay. Next slide. Okay, we want to continue to be able to achieve sustainable growth in developing market, and this is Indonesia that I'm talking about. Okay, if you look at some of the healthcare statistic from Indonesia, Indonesia has 1.04 hospital bed per 1,000 people. So this is actually amongst the, I would say this is actually one of the lowest rate in the ASEAN country. So coupled with the growth of the Indonesia middle income population, as well as over the last couple of years, the Indonesian government has been introducing this universal healthcare insurance, for the Indonesian population. This has driven a lot of demand in the healthcare sector. Okay, hence we believe that Indonesia continue to be a good market for us to be in. And prior to 2021, this is actually our rental structure. Okay, so prior to 2021, our rent escalation is that we will get 2x Singapore CPI, but there's a cap at 2%. Okay, and there is a variable component. This variable component actually vary between 0 to 2%, but this variable component is something like a bonus component. It's not cumulative. So every year we will look at the performance of the operator, the hospital performance, and we will be able to assess whether this particular hospital be able to give us any variable rent. And this variable rent only is range between 0 to 2% of the total rental income. Okay, and if the hospital doesn't perform well, we will not get any of the variable component. We will get the base rent, which is increased by 2%. Okay, and the total rent payable will be base plus the variable. If there's any variable, it will be added on to the total rent. And the tenure, which I explained earlier on, is actually 15 years with option to renew for another 15 years by mutual agreement. And the currency before 2021 is actually in Sing dollar. Okay, and post the restructuring in 2021, okay, we will receive the rental in Indonesia rupiah, but we have a higher annual escalation now. It will be 4.5% annually. So every year, the base rent will increase by 4.5%. And this 4.5% is actually partly to also to mitigate the volatility of the Indonesia rupiah currency. Hence, you see that the current, the new rental escalation is more than double the old leases. Okay, and on top of that, there's also a performance-based rent. Okay, this performance-based rent is actually 8% of the preceding financial year hospital gross operating revenue. Okay, so what we do is that we will be looking at our base rent, which is increased by 4.5% versus this 8% of the hospital gross operating revenue, and we will compare these two numbers. Whichever is higher, we will take the higher number as our total rent for the particular year. Okay, so I'm also glad to report that there are a couple of hospitals, about 3 or 4 of them, has already moved on to this performance-based rent. That means they are paying slightly higher than the base plus 4.5% annual escalation. Okay, so in terms of the tenure of the leases is similar to before the restructuring, 15 years with option to renew for 15 years. Okay, one thing to note that all our Indonesia leases are all on triple net. Okay, so what I mean by triple net is that the operator or the tenant will take care of the daily upkeep of the hospital. They will also bear the insurance cost as well as they will pay for the property tax of the asset. Okay, and I also shared early on, as part of our strategy, as part of our capital recycling growth plan, is that we have divested Siloam Hospital Surabaya, which this is the asset that we have held on to since the IPO, and this is the asset that I also shared early on that it's getting a bit old. Hence, we take the opportunity to realize the full value for this particular asset, and this divestment was completed sometime last month. Okay, next slide. Okay, as we continue to bring it sustainable in the developing market, we also want to diversify in the developed market. So on this part, I've shared early on that our target is that we want to be able to grow our proportion in the developed market to more than 50% of our asset under management in the next 3 to 5 years. this developed market that I'm talking about is that, other than Singapore, Japan, we're also looking at Australia, UK, Europe, and perhaps even US. Okay, so on this front, we have made our maiden acquisition in Japan sometime first quarter of this year. We have actually acquired 12 quality nursing home in Japan from our sponsor, Oyui Lipo Healthcare. Okay, yeah, this was actually completed in March this year, and then subsequent to that, in last month we also have acquired another 2 quality freehold nursing home from third party. The other 2 nursing homes actually come from a third party. Okay, so that will also help us to reduce as well as mitigate our geographical as well as tenant concentration risk. So as of current, Indonesia portfolio is now only about 73%, whereas the other 27% is already in the developed market in Japan as well as Singapore. So our goal over the next 3 years is that we want to further increase the proportion of the developed market to more than 50% of our AUM. And within the first year, we already done more than half of the work, and we are confident that within the next 3 to 5 years, we will be able to achieve this goal. Okay, next. Okay, I'll share a little bit more about our nursing home in Japan. Okay, we have a total of 14 nursing homes in Japan, and these are all operated by independent, well-established, as well as experienced local nursing home operator. As of now, we have 5 operator tenants for us. Okay, and these are operators that are very experienced. They have very long track record. In fact, if you look at the Hickory High, they have more than 35 years of experience, and basically they operate 7 of our nursing home in Sapporo area, and this particular company is actually listed in Sapporo Stock Exchange. Okay, and then the other operator, they also have many years experience. In fact, the one with the least experience also have 8 years in the market, and they actually operate 2 of them in Nagano as well as 1 in Kyoto. And recently, we managed to source for a nursing home that is actually operated by the second largest nursing home operator in Japan. But their market share is only about 3.2%, and they actually operate close to 300 over nursing home. So the Japan nursing home market is kind of like quite fragmented. There are probably 10,000, more than 10,000 of the nursing home there. So we see a lot of opportunity, for us to expand our portfolio, over in this particular country. And most of you would know that Japan also has this major issue with the aging population, and certainly this is a market that we believe that it will continue to grow over the next couple of years, and it will continue to give us attractive for us. And at the same time, we also aware that Japan interest rate continue to be very low, and this is the reason why it will allow us to be able to acquire as well as fund the nursing home over in Japan. Next slide. Okay, part of the strategy that we have is also to reshape our portfolio for capital efficient growth. And I just want to touch on these 2 assets. Of course, the first one I will share early on is that we have diversified we have actually divested the hospital in Surabaya. Okay, and this is actually one of the assets that we have in the past, entered into this development work agreement to build a new hospital, because this particular hospital was actually built in the 1977. So this particular hospital has been very old, and the operator actually would require a new hospital, to help them even as they expand the market over there. So a couple of years ago, we have actually entered into this agreement to help them to build a new hospital, but there are some issue. There's an accident that happened at the site area, and then subsequently we have to terminate the project, and we are able to recover all the money that we have actually injected into this project, as well as receive some interest payment for the amount that we have injected in, and the total settlement amount of 30.6 million was fully received in June this year. Hence, we have decided that it may be best for us to divest this particular hospital. And so subsequent to the settlement project, we also have divested this particular hospital last month. And the proceed that we received for this particular hospital is actually 143% over the original purchase price. We actually bought this asset during IPO in 2006. So the last 15 years, we're receiving the rental income, and then on top of that, we also have made a very decent profit, for this divestment as well. And that this particular gain, we are able to recycle into other area, and also part of the proceed can also be used to pay down debt or finance any acquisition which we have done, by subsequently buying the two asset or two nursing home in Japan. Okay. Next, another asset that we have identified, as part of the reshaping of portfolio is to divest this hotel and country club. Okay, this is a non-core asset which was also with us since IPO. Okay, and we already appoint a marketing agent. Okay, Colliers International Indonesia to help us to look for a suitable buyer. The price value for this particular asset is around 32 million. Because we are trying to divest this particular asset, hence we have actually signed a very short-term lease with the tenant. Okay, the lease is actually up for renewal by December this year. So we are in the midst of negotiating with the tenant, to extend the lease by another year or so, so that it will provide revenue stability, while we are looking at divesting this asset. Next. So another area that we are working on is also to strengthen our capital structure as we look to grow as well as extend our portfolio. Okay, so on this part, we have actually done a couple of things. Okay, firstly, we also have actually issued the 100 million 5-year guarantee bond of 3.25%. This was actually done completed in April this year, and the coupon is actually payable semi-annually in arrears. So we are definitely very happy that we are able to get this thing done half a year ago. If we were to do it currently, I think we will definitely be very challenging, and probably the market is not even available for us to actually do anything right now because of all these rising interest rate at the moment. And one thing to note about this 100 million guarantee bond is that this is actually the first ever healthcare social bond to be done in Singapore, and this is actually rated AA by S&P, and this is also being guaranteed by CGIF. CGIF is a trust fund of the Asian Development Bank, and this is also the first time that CGIF has provided a credit guarantee to a social bond that's issued within the REIT market as well as debt market in Singapore. Okay, and subsequent to that, we also have managed to secure 1.66 billion Japanese yen. This is also in the form of a social bond from a bank in Japan, Shinsei Bank Limited. Shinsei Bank Limited is a leading diversified Japan financial institute. Okay, and this particular loan that we secure is actually part of the loan that we use to finance the acquisition of the two Japan nursing home that was completed in September, just a month ago. Okay. Yeah, and also last month we also able to successfully make a tender offer for the outstanding perpetual security that we currently have, and we have actually received a very good acceptance rate. 45% of the perpetual holder has tendered to our offer, and you know, this is actually a voluntary tender exercise, and this voluntary tender acceptance rate reflects the positive reception that the perp holder has to our offer, because this particular offer actually is quite a significant premium over the secondary market price. So this is you know, something that we are able to help, and we also have made some gain, you know, on this perp acceptance, which will benefit the unit holder going forward as well. Okay, just want to cover a bit on our capital or debt structure. So as at June this year, our total debt is around 462 million. Our gearing ratio is about 33 or 35.6%, and our weighted average debt is about 1.3 years. Our total cost of debt on an all-in basis is around 3.7% per annum. Okay, it's lower than last year because of the new Japan nursing home portfolio. Okay, because if you look, shared earlier on, you know, when we are able to borrow Japanese yen at a lower interest rate, hence we are able to lower our total cost of debt to a lower number. Okay, and our interest cover ratio is still very healthy at about 5.6 times. In terms of the debt maturity profile, we have about 250 million that will be due in first quarter of next year. Currently, we are in negotiation with our existing lender to refinance this term loan. Okay, we don't see any issue or any problem with this refinancing. In fact, we are negotiating with them in terms of the margin as well as the interest rate. So we're confident that it will be done soon, and then we will make the appropriate announcement, you know, as and when we are able to sign any definitive agreement with the bank going forward. And once we are able to refinance this loan due first quarter of next year, there will not be any refinancing need until year 2025, which is the TMK bond that will be due. And this is actually the TMK bond that we have assumed over when we acquire the Japan portfolio sometime early this year. Next slide. Okay, I just want to share a bit on the positive outlook for the healthcare sector as a whole. I just want to touch on maybe two areas. You know, first part is actually on the aging population demography, and then I will cover the under-penetrated healthcare sector over in the developed market, in particular Indonesia. Okay, so as most of you will know, that there's this common trend of an expected increase in the number of people that's aged 65 years and over between 2019 and 2030. If you look at the slide, you know, some of these developed countries that we are keen to explore, you know, see growing aging population that's above the world average. You know, Japan, for instance, you know, by 2030, a third of the population will be above 65 years and above. And then even in Europe, Singapore, US, even Australia, 1/5 or even 1/4 of the population will be 65 years and above. So clearly there is a lot of potential in the nursing home, aged home, living care market that is in this country. Yeah. And then over at Indonesia side, I also shared early on that Indonesia has only 1.04 hospital bed per 1,000 people to service their population, which is around 260, 270 million people. And this is actually 4 times less than the Asia Pacific average of around 4.5 hospital bed per 1,000 people. So clearly there is a lot of growth potential over at the Indonesia side, and there are certainly a lack of quality healthcare facility over there as well. Okay, so potentially we see very positive outlook in the market, in the healthcare market that we are in at the moment. Yeah. Okay, a couple of slides before I end my presentation. Post the restructuring, we are able to give out very stable DPU. Then, okay, if you look at our net property and other income, the fourth quarter of 2021, you see a huge spike there is actually due to this one-off accounting adjustment. So even if we were to strip off that one-off accounting adjustment, you'll see that our NPI has also been steadily rising. And if you look at our DPU over the last 6 quarters or so, we are able to deliver very consistent and stable DPU. And in terms of the NPI reduced concentration risk, we are also able to reduce our reliance, on the Indonesia side to in the past it's about 95+% to about 88%, and as we diversify into different market, this proportion will reduce even further in time to come. And in the past, we only have a few third-party tenants, but since this year we are able to bring on more third-party tenants so that we can also reduce our tenant diversification going forward. Yeah. So just to summarize, now that we have support of our strong sponsor OUE as well as OUE Lipo Healthcare, and also we put in place this First REIT 2.0 growth strategy. We remain committed, and we want to balance our growth as well as stability in our portfolio, so that we can continue to deliver sustainable distribution to our unit holder. Okay, I think that is all I have for my presentation. Maybe I'll just open the floor to Q&A now.
Yeah, thank you, Victor, for that illuminating presentation on the First REIT. I think we can go to the Q&A now from the audience. Okay, so first question. Hi, Victor. What kind of developed markets does First REIT plan to go into? No doubt the Japan asset should render stable income, but the depreciation of the Japanese yen does not bode well for unit holders. Are there any dividend accretive plans in the pipeline? I am a unit holder. So Victor, what are your thoughts on that?
Yeah, I think I also shared early on that obviously I've identified a couple of developed markets. Of course, one of the developed markets that we are keen and we have actually went in quite a big way is actually the Japan. Yeah, I mean, you're right to say that we went in sometime early this year, and the time the Japanese yen was at a certain number, and it has since depreciated quite a fair bit. Yes, we are fully aware of that, and obviously we will continue to look at this Japan asset, and obviously for us to acquire now is a lot cheaper as compared to a couple of months ago. And of course, part of the plan, for us to actually look at is also to hedge the Japanese currency going forward as well. And the reason why Japanese market is and continue to be attractive for us, because this is a market that is very stable, because of some of the demography that I've shared earlier on in my slide. And also, they continue to give us very, very decent yield, which is around 4 to 5%. And the interest costs continue to be very low at the moment. We can borrow at around 1 or sub 1%. And there is a cushion, or there's a margin, a gap of 200 to 300 basis points. So as we continue to acquire the asset in Japan, and if we are able to fund the bulk of the acquisition by debt, it will definitely be accretive for us, and it will help us to improve our DPU to our unit holder.
Okay, thanks for that, Victor. Next question. Okay, so I guess maybe this wasn't touched on, but please advise the rental yields for the properties based on the price paid by First REIT for the properties in Japan and Singapore.
Yeah, I think I briefly touched on the yield just now in my earlier answer. For the nursing home in Japan, the yield that we are looking at is probably about 4+, close to 5%, or depends on the area or the city that we go in. It can go slightly above 5% as well. Singapore side, the 3 nursing home that we have was acquired many years ago, way back in 2007. And that time, we are able to achieve a very, very good yield of about 7 to 8%. But obviously, in recent time, there isn't any nursing home that's up for sale. But I reckon that if there's any nursing home that's up for the market, the yield will probably be maybe around 4 to 5% as well. Yeah.
Okay, sure. Thanks. Next question. Okay, so you mentioned First REIT will also acquire hospitals. What's the rental yield or per bed price would make sense, for example, in Singapore or elsewhere, in view of the rising interest rate environment for REITs in general?
Yeah, hospital is definitely that we will be looking at, because this is actually part of the healthcare portfolio that we have. Yeah, it depends on the country that we will be going into. I mean, for the developed market, I would say that the yield for hospital will probably be looking at 5 to 6%. Yeah, of course, with the rising interest rate environment, it makes us a bit challenging for us to actually go into this developed market to acquire asset at this moment. But we will continue to explore, and then if we've come across any asset or any hospital that give us a very good yield, and then when the interest rate environment is more or less settled, maybe that would be a good time for us to explore the asset as well.
Okay, thank you. Next question. Okay, so I think this is an interesting one on Indonesia. So how do you evaluate investing in Indonesia versus the difficulty of doing business there? I guess corporate governance concerns, local competition, the fluctuating Indonesian rupiah, the FX, etc. So yeah, what are your thoughts on that, Victor?
Yeah, sure. Okay, the reason why we are in Indonesia is because our sponsor actually was originated from there. So obviously, with a local sponsor, a local partner will help us to negotiate, some of the legal, tax, or even competition issue that's over there as well. Yeah, the fluctuation currency has always been a concern in the past. But if you look at the Indonesian rupiah, for the last couple of years, it has been very, very stable, and largely also because of the strength of the Indonesia economy, as well as, of course, their commodity market is doing very well there as well. Yeah, so I think this is certainly something that we will definitely have to factor into. You need to have a good local partner to help you, and of course, currency. I think we definitely have to look at hedging the forex. This is definitely something that we are monitoring very closely, and then perhaps we will be able to enter into some form of hedging mechanism going forward, especially part of our portfolio is still in Indonesia.
Okay, thank you for shedding some light on that. Okay, we have one final question from the audience. So here we go. What is the decision point, or how do you come to the decision on whether to keep an asset or to sell it to recycle the capital?
Yeah. Okay. I mean, okay. When we are looking at acquiring any asset, I think one of the criteria that we will study is that we also, besides looking at whether the asset give us good yield, good return, we are also looking at whether there are growth or as well as development potential, so that going forward, we can also increase or improve our income or rental, for the particular asset. So likewise, if we were to consider selling that particular asset, I mean, one area that we will have to consider is that whether is that particular asset realize its full potential, whether this is an asset that we feel that maybe going forward, the value will probably going to come down. And this is one of the reasons why we have decided that we want to divest the hospital in Surabaya, because this is an old asset, and we know that in the past the operator has expressed a need that they want to build a new hospital. Hence, we feel that this is the right moment for us to divest this particular asset.
Okay, thanks. I think we may have one or two more questions, actually. I was mistaken. Sure. I think we've got a couple more. Okay, so I guess here we can combine a couple from the audience here. What's the First REIT's distribution payout policy, and could this policy, for unit holders, be impacted by the ongoing rollout of First REIT's 2.0 growth strategy?
Okay, our distribution policy has been that, for REITs, right, we have to distribute out at least 90% of our distributable income. Okay, but since IPO, we have always been distributing close to 100% of our distributable income. So I would say that this policy will continue to remain. And then, our 2.0 growth strategy that we have rolled out since last year will complement this our dividend policy, and I feel that it will definitely not impact our distribution payout policy going forward.
Okay, I think that's it. Thank you, Victor, for your time today. Participants, audience, if you could just give us some quick feedback on the session via the QR code. It won't take longer than a few minutes. That would be much appreciated. So thank you, Victor, and thank you, First REIT, for taking the time out, and thank you to our audience for taking time out of their lunchtime to join us today. So thanks everyone for appearing today, and we'll see you soon. Bye.
Thank you so much, team. Thanks.
Thank you. Thanks. Bye.
Bye.